Artificial intelligence, quantum computing, electric cars, all these seem to be the most disruptive investments of recent years. But you may not know that they depend on a single factor: cheap energy. And here's the truth: today, energy is not only expensive, but it could become even more unaffordable. So there's a big opportunity. Some companies are changing the rules of the game. If you know where to look, you could be ahead of one of the biggest economic revolutions of our era. In this video, I will explain why energy has become so expensive, what solutions are in place, and how to take advantage of this trend. To do this, I will use information from the latest Big Ideas report from Ark Invest, the company owned by the famous investor Cathie Wood, which we have spoken about in our previous video. A little spoiler: energy demand will grow up by up to 40% in the next few years, driven by AI. So let's look at the key drivers of this change and which companies are at the forefront to invest wisely. You may not have jumped on the NVIDIA investment bandwagon, but you won't want to miss out on this opportunity, according to Cathie Wood. As always, I would like to remind you that if you like this content, please subscribe to the channel and share it with anyone who you think might be interested. And of course, you will find a link to our weekly newsletter in the video description below. Let's start with what many of us are concerned about. Why has energy become so expensive in recent years? Let's think back to the middle of the last decade. Back then, we enjoyed relatively low prices. Many experts argue that it was thanks to the great economic crisis we went through. You know, when the economy cools down, demand for oil and gas falls. And of course, if supply is maintained until inventories adjust to the new demand situation, prices tend to fall. Another good reason was the entry of the US into the oil market. With Trump's return, he plans to continue expanding fracking production. However, much of the rise in prices that we have experienced in recent years, beyond geopolitical conflicts, can be explained by what many are already calling the failure of ESG investment. Let's just say that about 10 years ago, due to propaganda from Western political elites, it was assumed that the ecological transition would be much more advanced. This put the brakes on investment in new oil and gas fields. And it makes sense, doesn't it? Why invest in expanding expensive gas fields when I can pay my shareholders handsomely via dividends? After all, in 10 to 15 years, energy will be mainly green. So what is the problem today? Well, it's simply that now this transition doesn't seem so imminent, beyond putting some solar panels on the house or having your BYD plugged into the garage. So as of today, we find that, on one hand, green energy has not been as efficient as we hoped it would be. In fact, most ESG-themed funds have lost between 20 and 40%. On the other hand, they did not reinvest as much as they should have in intensifying extraction processes to generate energy by traditional means. On the contrary, even dozens of nuclear power plants were shut down. The conclusion is obvious: we need cheap energy, and we need it now. We know that from Jevons paradox that the cheaper an essential resource, energy, oil, gas, etc. becomes, the more and more of it a society will need to consume, especially as technology advances and this progress permeates all layers of society. We could say that the key to the future will be cheap energy, but not just for our individual consumption, but for enabling the huge technological revolutions that are coming. Finally, quantum computing, or the new space race we have already talked about, will obviously require enormous amounts of energy. Of course, the conflict in Ukraine and the new bloc economy that seems to be forming does not help either. In fact, geopolitical tensions make energy production and distribution even more expensive. However, the team at Ark Invest are optimistic and believe that despite everything, the desire for progress and development will win out over geopolitical frictions. And why? Well, that is exactly what we are going to see now. Why invest in energy? According to the insights drawn by Cathie Wood's team in Ark Invest's Big Ideas report, these are the 3 key reasons that could make it worthwhile. Increased need for AI-driven power capacity. First, let's talk about the additional demand that AI alone requires. Data centers, server farms all require a lot of power to run. To give you an idea, we are currently consuming around 28 to 30,000 billion kilowatt hours per year. And the report itself suggests that we could reach 34 to 40,000 in just 5 to 7 years, which would mean an annual growth of between 4.5 and 7.3%. That is, of course, as long as our new plants or extensions are built as forecast and demand for AI continues to rise at the current rate. This sector will continue to grow a lot. Reason number 2, the return to fashion of nuclear energy. Until the mid-1970s, nuclear power helped to reduce electricity costs enormously. However, after the passage of the Energy Reorganization Act of 1974, much stricter regulation was imposed, which alongside other factors made nuclear power plant construction projects more expensive. But now we seem to be facing a new scenario. The energy emergency has prompted the idea of a much friendlier regulatory framework, which could start to bring down electricity prices in the long term. And it is not just a question of the public sector. The private sector also seems to have a certain appetite for nuclear power. And giants such as Amazon, Google, and Microsoft are already starting to develop their own mini-nuclear reactors in order to be somewhat more independent and efficient in obtaining cheap energy. Opportunities in renewables and storage. Going part of the way does not mean going the wrong way. Lithium-ion battery technology, as well as the emergence of new chemistries, has lowered energy storage costs, which could allow solar or wind power plants to be much more efficient, even in periods of low generation. However, the interesting thing will be in the mix of both energies, both 100% renewable and relatively cheap but using intermittent production, with others that are more stable and capable of generating abundant production in a predictable way. All in all, Ark Invest's Big Ideas report concludes that another energy investment cycle could be on the horizon, with the aim of making energy consumption cheaper in the long term. In the short term, however, this would translate into tax breaks and even subsidies to make the energy mix as efficient as possible. Now, you may be wondering, what kind of companies would benefit the most, and what would be the best way to gain exposure to energy? Well, today I will introduce you to two companies that are giving a lot to talk about, as well as our usual indexed option. But before we get started, I just want to remind you that I'm not a professional financial advisor. My goal is to share information and analysis based on reliable sources to help you make informed decisions. However, this is only an opinion, and I encourage you to do your own research before investing. That said, let's get started. Let's start with Constellation Energy Corporation. This is the largest producer of carbon-free energy in the United States. Based in Baltimore, it supplies electricity and gas to 2 million customers. More interesting, however, are its plans for the future, as it recently bought Calpian Corporation for $26.6 billion, an acquisition that will allow it to expand its strategic presence in key markets such as Texas, California, and the northeastern United States. Meanwhile, in terms of its financial metrics, they're not bad. Its operating profit has not stopped growing, even at double digits over the last 4 years, which has also translated into earnings per share, growing between 25% and 50% annually. As well as this, its dividend yield, although not currently the most attractive, already stands at 0.6%, which gives it plenty of room to grow over the next few years, especially as many of its current investments mature. Meanwhile, on the technical side, we see a clear uptrend of more than a year and a half. However, with pullbacks after breaking through the resistance of the channel. Moreover, it seems that at the current moment, there is weak volume and bearish divergences in the RSI for several months, so we would expect the share price to fall back to the bottom of the bullish channel. Overall, it looks like an interesting stock to keep on the radar, although personally I would wait a few weeks before entering to see what happens to the price. Also, with a PE ratio of 35 times, it could show some signs of overvaluation compared to the market average. Let's move on to the next stock, Duke Energy. Duke Energy is one of the largest energy companies in the United States, headquartered in North Carolina. It supplies electricity to 8.4 million customers in 6 states and natural gas to 1.7 million customers in 5 other states. With a total energy capacity of 54,800 megawatts, it has established itself as one of the key players in the US energy landscape. But most interesting is its recent $83 billion investment plan for the next 5 years, a 13.7% increase over the previous plan. In essence, the company is looking to bolster its electricity infrastructure to meet the growing demand for data centers and industrial electrification. In addition, Duke Energy plans to add nearly 5 gigawatts of natural gas generation capacity by the end of 2029, further boosting its presence in this segment. And if we look at its financial metrics, they don't look bad. In fact, its operating profits have been growing at rates of more than 20% per year, while earnings per share have also been rising, albeit somewhat more moderately. However, there is a certain inability to transform its earnings into free cash flow, probably due to the heavy investments in increasing energy generation capacity. Meanwhile, the chart shows a scenario of some indecision. After breaking the historical resistance around $110 per share, this break has yet to be confirmed. In this case, an interesting idea could be to wait for the price to move back to that old resistance, now converted into support, around $108 or $110 per share. And once there, wait to see what happens with the volume that may enter that area, as this would confirm that the uptrend remains strong. Now, of all factors considered, Duke Energy does not seem like a bad idea to keep on the radar. It is true that it maintains a negative free cash flow, but we cannot forget that this is due to its ambitious reinvestment plan to improve its power generation bandwidth. Moreover, with the price-earnings ratio close to 20 times, this is not an exaggerated valuation. In fact, just a slight pullback in price could make it a very attractive opportunity, especially for those looking for a long-term exposure to the energy sector. Well, we have seen two very interesting companies, but aren't you wondering how to diversify in the US energy sector without having to bet on just one company? Which is why I'm presenting you with a very interesting solution, the iShares S&P 500 Utilities Sector UCITS ETF. This ETF, managed by BlackRock, seeks to replicate the performance of the S&P 500 Utilities Select Sector Index, an index that includes the main energy utilities companies within the S&P 500. In fact, the top 10 positions alone account for around 55% of the portfolio, with names as powerful as Next Energy or the aforementioned Duke Energy and Constellation Energy. As I said, it is sometimes easier to invest in a whole sector through a single product rather than choosing companies one by one. In this way, the fund uses physical replication, i.e. it directly buys the stocks that make up the index, which translates into a very close correlation with its benchmark. In addition, it is an accumulation ETF, which means that it reinvests dividends rather than distributing them, making it a very interesting option for investors who prefer to automatically increase their position without receiving cash payments. And in terms of costs, its TER of 0.15% per annum makes it quite competitive, especially when compared to other sectoral products in the market. In general, if we look at it in perspective, the last 5 years have been positive for this fund, with a revaluation of approximately 35%, which is not bad at all, considering the stability and defensive nature of the energy sector. In other words, with an alternative such as this ETF, we will not see spectacular rises overnight, but we will see gradual and steady growth, which is what investors normally value when they approach this type of sector. That is all that we've got today, so if you believe that our future lies in abundant, cheap energy production, this type of investment may fit your strategy perfectly. In the end, if technology is the key to a better life, cheap energy will be the fuel that makes it possible. And that means that by investing in energy, you are not only looking to make money, which is also true, but also to bet on the continued optimism and growth of our society. So if you like this video, don't forget to like, comment and subscribe to the channel, so you don't miss any new videos in the future, and leave your thoughts in the comments. And I'll see you in the next video.